With data from China, Europe and the UK scheduled for release this week, there'll be quite enough to keep economists busy as they try to judge how the global economy is holding up. Although from the point of view of consumers, the most important figure will be the latest headline inflation number in the UK. The Office for National Statistics will publish this on Wednesday the 21st of October. The ONS and the Bank of England's preferred metric is the CPIH index, which includes owner-occupier housing costs. Although the consumer on the street is more likely to be familiar with the Consumer Price Index, CPI, or the Retail Price Index, RPI, even if the latter is no longer an officially recognised statistic. These latest numbers will refer to September. Just to remind you that the year-on-year increase in the cost of living in August was as follows, at least according to the official figures: 0.5% based on the CPIH, 0.2% based on the CPI, and 0.5% based on the RPI. The trend's pretty clear at the moment, downward, although weak oil prices and the broader economic downturn in the spring, and then falling prices in restaurants and cafes thanks to the Eat Out scheme in August, have had a role to play here. The latest dataset did flag the rising cost of toys, games, hobbies, hotels, road transport services and second-hand cars. Let's see what September brings. Some economists and analysts still think disinflation or even deflation will result from the pandemic, thanks to the loss of jobs and income, depressed economic activity, and demand destruction. Others assert that inflation will result because of central banks' quantitative easing schemes, government fiscal stimulus and deficit accumulation, and the destruction of supply as businesses close and global supply chains are disrupted. On the corporate front, almost a sixth of the FTSE 100 is due to publish quarterly results or a trading statement of some kind, with a few mid and small caps set to update their shareholders for good measure. Names which may be particularly worthy of note, for insights into their own businesses or target industry, or even the wider economy, include the following. Minor BHP Group on Monday the 19th of October, Dettol maker Reckitt Benckiser, house builder Bellway, and gambling services provider Gamesys on Tuesday the 20th. Real estate investment trust Segro, copper miner Antofagasta, and silver producer Fresnillo on the 21st. Another miner, Anglo American, Unilever, academic publisher Relics, pest controller Rentokil Kill Initial, builders merchants Travis Perkins, and FTSE 250 precision instrument makers Spectris and Renishaw, all on the 22nd, before London Stock Exchange and Intercontinental Hotels round out the week on Friday the 23rd of October. Now that's a pretty big list, but for me the company most capable of causing a fuss in the week ahead is Barclays. The bank is scheduled to be the first of the big five FTSE 100 lenders to release its third quarter results when it does so on Friday the 23rd of October. In some ways, the less said about the share price, the better. Barclays is down by a quarter over the past year, much worse than the FTSE 100's 17% slide over the same time frame. Shareholders can try to take some comfort from how the shares are looking to pull away from the lows reached in spring, although a long-term perspective reveals the true horror of it all. The shares trade no higher now than they did in 1991, smack in the middle of a recession almost 30 years ago. I guess that does at least set the bar of expectations fairly low, and Barclays' website reveals that the consensus analyst pre-tax profit forecast for the third quarter is £507 million. That's actually an improvement on last year, but that was when the final slug of payment protection insurance claims went through the books at a cost of £1.6 billion. For the first 9 months of the year, Barclays is expected to record a pre-tax income of £1.8 billion, down from £3.3 billion a year ago. So why the profits plunge? Well, analysts will look to two factors in particular. The first is provisions against loans which have gone sour or may be about to do so because of the economic downturn. They are expected to cost around £1 billion in the third quarter, up from £461 million a year ago. To accentuate the positive, that's at least a drop from the numbers seen in Q1 and Q2. The second problem is the net interest margin, the degree of profit that Barclays is making on its loan book. This is being hobbled by central banks slashing interest rates to nearly zero and holding bond yields down via their quantitative easing policies. In Q2, the net interest margin was 2.69% at Barclays UK, down from 3.05% a year before. Now, you might not think that 0.36% matters very much, but on a loan book of £355 billion, that's just cost you over £1 billion in income over the course of a full year. The good news could come from Barclays International, which is home to the investment bank, a much maligned investment bank as well. Financial markets have been volatile but generally buoyant, and there's been plenty of new issuance in the stock and bond markets, while merger and acquisition activity has been lively too. Barclays International seen making a pre-tax profit of £634 million compared to just £7 million from Barclays UK, with overhead and headquarters costs shipping in a loss. 2 final points, if I may. Remember, there'll be no dividends or share buybacks this quarter, as the Bank of England has ruled these out for calendar 2020 due to the pandemic. But analysts do expect a full-year payment of 1.9p a share. That would have to be declared alongside the fourth quarter figures in calendar 2021, so watch out for any hints there. Finally, shareholders will be looking for any comments on Barclays' leadership. There have been hints that embattled boss Jez Staley may leave by the end of 2021, especially after September's reshuffle of senior management heads. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.